Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Now, coming to this capital structure chapter, let us set the initial context. The term capital, when we learned, means long term money. And in the earlier chapter, which is chapter 4, we learned about cost of capital. What is cost of capital? Is cost of debt, cost of equity, cost of preference, weighted average, book value weights, market value weights, and then we were doing the WACC. In the previous chapter, our focus was only getting WACC. We never focused on which is the right mix for the company. What is right mix is some company 50% debt, 50% equity. Some company maybe 80% debt, 20% equity. Some company better is 40% debt, 20% preference, 40%. Which is the better mix for the company? Which is the better mix for the company? In this chapter, we are going to learn capital means long-term money. Capital structure means composition of this long-term money, and optimum capital structure means one which minimizes WACC, or something called as maximizes value of firm. What is that maximization? As we proceed, you will understand. But the objective of the chapter is very simple. We are trying to either minimize the cost of capital or maximize the value of firm. Previous chapter, when we did cost of capital, we were focusing on calculating the cost of capital. Our focus was only computation of cost of capital. In this chapter, the focus is first is computation, but post computation, I also want to understand how can it be minimized. Now, if my cost of capital is lower, it indirectly will lead to improvement in valuation. Reason is very simple. Cost of capital, if I'm paying lower cost and earning more, market will start giving a better valuation to the company. Market will give better valuation to the company. Lower cost of capital and higher lower cost of capital. Lower cost means more profits means better valuation. This is the broad logic. Okay, now in order to calculate the value of firm, we do something like this. We start with EBIT. How is EBIT calculated? A step before this is sales less variable cost, contribution less fixed cost, EBIT. From there we subtract interest. Objective could be to minimize the interest expense also. You get EBT, deduct tax, EAT, deduct preference dividend, EAES, EPS. Till this was leverages format. Not till this, even before this. Even before this is what? Sales less variable cost, contribution less fixed cost, EBIT. Once you get earnings per share, what can happen is we learnt a formula called price earning multiple, which is called price by earning, MPS divided by EPS. You cross multiply, PE into EPS is equal to price. PE into EPS equal to price. So first we will calculate earnings per share. This earnings per share is not calculated once. It will be calculated saying that particulars. Option 1, 100% equity. Option 2, 50% debt, 50% equity. Option 3, 40% debt, 20% preference, 40% equity. Like that, multiple options will be there. For every option, we will calculate EPS. With the EPS, you multiply with P multiple, you will get market price per share. Market price what? Per share. Multiply with number of shares, you get market value of equity. Market price per share. Per share multiply with what? Number of shares. And finally, the meaning of word capital is what? Long term money. Long term money means debt, equity, preference. Objective is to maximize the value of firm. Value of firm is, firm means all three put together. All three put together. Option 1, market value of firm 2 CR. Option 2, 2.5 CR. Option 3, 3 CR. Option 3 is the best. Option 3 is the best. Option 3 is the best. This is the objective of the chapter. We will be given multiple options. We need to go ahead and find out one which maximizes the value of firm. One which maximizes the value of firm. One which maximizes the value of firm. But one issue is, some question, your calculation will stop at this itself, at earnings per share itself. Reason, price earning multiple is not given. Not given, I can't proceed beyond that. Price earning multiple not given. Put a full stop at EPS itself. Put a full stop at EPS and find out which combination gives us maximum earnings per share. This is the broad idea. Okay, what are we trying to do here? Let us understand this also now. Now what can happen is something like this. We will do particulars and let's take two alternative. Alternative 1, 100% equity. Alternative 2, 50% debt and 50% equity. 50% debt and 50% equity. There are two alternatives we have: 100% equity, 50% debt and 50% equity. We start with EBIT. Till EBIT, it does not depend on the capital structure. Till EBIT depends on marginal costing. Marginal costing means operations. After EBIT, capital structure changes, interest will change. Capital structure changes, number of equity share will change. Capital structure changes, preference dividend will change. So let us assume both we are making 10 lakh, 10 lakh. Less interest, 100% equity, no interest. 100% equity, no interest expense. This side interest expenses 2 lakh. Random number, don't worry about it. Okay, random number. We will get what? EB 8 lakh, 10 lakh and 8 lakh. 10 lakh and 8 lakh. After EBT, less tax at 40%. Tax at some percentage would be given in the question. 4 lakh, 3 lakh 20. You get EAT, which is what? 6 lakh, 4 lakh 80. Less preference dividend. Preference dividend, which is not there because no preference dividend I have taken. 0 EAES 6 lakh, 4 lakh 80. Number of equity shares 10,000, 5,000. 10,000 and 5,000. One has more equity share, second one has lesser. It can be 10, 5, whatever. We'll do all this calculation as we do the problem. Once you divide, you get what? Earnings per share. Divide and tell me the value. Earnings per share. 6 lakh divided by 10,000 is how much? Sorry? 60 and some question. Stop at this stage. Stop at this stage and say alternative 2 is the best for the company. Say what? Alternative 2. That is 50% debt, 50% equity combination is best. 50% debt, 50% equity combination is what? Best for the company. 50% debt and 50% equity combination is best for the company. Sometimes we may proceed further. What is proceed further? Price earning multiple, which can be same for both, can be different also, whatever the question gives. Let's assume this is 10, this is 8. 10 and 8. 10 and 8. I get market price per share. I get what? Market price per share, which is nothing but 60 into 10, 600 96 into 8, how much? Some question may say stop at MPS also. Some question may say stop at MPS. Which is better in MPS now? Alternative 2 is better. It is not necessary that EPS better means MPS has to be better. For example, if this was only 5, if this was only 5, 96 into 5 would have become 480. 96 into 5 would have become 480. Any doubts till this? Then we repeat. Number of equity shares, which is 10,000, 5,000, multiply market value of equity, multiply market value of equity. 600 into 10,000, how much? 60 lakh. 768 into 5,000. Okay? Some question may stop at this also. They say which has better market value of equity? Which has better market value of equity? Alternative 1. Either, see, this is one best one, or the best is the last one. In between, if they give something, the question will say which alternative should we select if the objective is to maximize MPS, if the objective is to maximize MV of equity, market value of equity. With this I add market value of preference, which is not there in both, market value of debt, not there obviously in this other one. It is, let's assume 20 lakh, 20 lakh, and I get market value of firm. Firm is debt plus equity plus preference, which is 60 lakh, 58 lakh, 40. Now, if the objective is EPS, if the objective is EPS, this is the best. If the objective is MPS, this is the best. If the objective is market value of equity, this is the best. If the objective is market value of firm, this is the best. Which one is to be maximized? Question may give some clarity. Any doubts till this? Understood? Clear on the workings till now? Understood what we are trying to do? Now this working has to be done not once, maybe twice, thrice, 4 times, 5 times, depending on how many options they give. I have seen ICAI giving 3 options normally. Any doubts till this? Clear? Okay. Now how we normally solve a problem is, first we identify the alternative. What is identifying alternative? 100% equity, 50% debt, 50% equity, 20% debt, 30% preference, 50% equity. For every alternative, I may try to calculate this separately. What will I calculate? Interest cost, because interest can change among the alternative. Preference dividend again can change among the alternative. Number of equity share, number of equity share. Somebody says no, I will not do a step 2, I'll directly do it in the step 3. That's your wish. I may calculate what? Interest cost separately for every alternative, preference dividend separately for every alternative, number of equity share for every alternative, and put it in this format. Put it in this format. When you put in this format, you may stop at EPS, you may stop at MPS, or you may stop at MV of firm, depending on what the question tells. If data is there on PE multiple, then only beyond EPS. Data not there on PE multiple, full stop. Full stop at EPS. Full stop at earnings per share. When we did leverages, our income statement, sometimes at PBT we were stopping, sometimes PAT we were stopping, sometimes EAES we were calculating, sometimes EPS we were calculating. Like that, you may stop at EPS, you may stop at MPS, you may stop at market value of equity, you may stop at market value of firm. Any doubts till this? This is the third main concept. All are interrelated concept only. Any doubts on this? Clear? This is another important thing which we need to be aware. ROI, ROCE and EBIT linkage. ROI, ROCE and EBIT linkage. What are we trying to do here? Now let us understand. A company EBIT today 20 lakh, it has debt, equity, preference. Okay, EBIT is 20 lakh, debt is 4 lakh, equity plus reserve is 10 lakh, preference is 11 lakh. Preference is 11 lakh. Can you tell me the total of all of this? 20. Can you tell me the formula for ROCE? We learned one formula called ROC, return on capital employed. What is the formula? Ratio analysis. You'll have to participate. I can't be telling this. EBIT by capital employed. EBIT by capital employed. Can you divide 20 lakh by 25 lakh? 80%. 80%. Now, this is existing scenario. What question will do is, they're saying we are trying to do something new. What is something new? Bharadwaj Institute wants to open one more branch. Wants to open one more branch. When I open one more branch, I need 10 lakh rupees. That 10 lakh, option 1 comes from debt. Option 2 comes from equity. Option 3 comes from preference. Wherever the money comes in, 25 lakh capital will become 35 lakh. 25 lakh capital will become what? 35 lakh. Where the money is going to come? Could be debt is added, could be equity is increased, could be preferences increased, could be all the three are increased partly. All put together we will reach what? Capital employed of 35 lakh. Capital employed of how much? 35 lakh. Now I have to start with EBIT for my analysis. The start is always EBIT for doing the table. Today with one branch we are earning 20 lakh. If I open another branch, obviously EBIT has to increase. May not double, but it has to increase. So what concept says is, we were earning 20 on 25 lakh, 80%. If 25 goes up to 35, assuming same 80% continues, assuming same what? 80% continues, you will now earn 35 lakh into 80%. You will earn now 35 lakh into 80%. You will earn how much? 35 lakh into 80%. How much is that? This is called ROCE and EBIT linkage. ROCE and what? EBIT linkage. I'll repeat again. Today we are earning 20 lakh with a capital of how much? 25 lakh. What is capital? Debt, equity, reserves, preference. Capital employed formula. Fixed assets plus current assets minus current liability are debt plus equity plus preference. If you increase capital employed, if you increase what? Capital employed, EBIT has to increase. Some question, they may even say 80% will become 90%. That the question may give. 80% will become what? 90%. Now on 90% on 35 lakh. Now on what? 90% on 35 lakh. I'll show this again now. New EBIT, new EBIT is equal to new ROCE, new ROCE, new capital employed. New ROCE into what? New capital employed. What is new capital employed? Earlier capital employed plus new capital raised. What is capital? Can be debt raised, can be equity raised, can be preference raised, it can be anything. I'll repeat again. We will be doing a rework scenario where the question will say that the company is going to increase its return by 5%. If it's going to increase return by 5%, earlier 80%, now 85%. Earlier 80%, now 85. Nothing is mentioned. Let us continue 80. But capital employed to 100% will go up. Capital employed, if you do any expansion, capital, what is capital employed? Debt plus equity plus preference. If somebody says fixed asset is going up, with the fixed asset something else has to go. With the fixed asset, it can be debt going up, it can be equity going up, it can be preference going up. Something has to increase. Able to first understand the concept? I'll repeat one more time, one more example. Particulars existing post expansion. Expansion could be anything which a company does. Existing and post expansion. Today EBIT 25 lakhs. Today EBIT is 25 lakh. Capital employed is 2 crore. What is this capital employed? Debt plus equity plus preference. How will we calculate? As we do questions, you will understand. Okay, but we have already seen this in ratio analysis. ROCE, or we also call ROI, EBIT by capital employed, 25 by 200 lakh, 8%. Question says ROI will increase by 4%. ROI will increase by 4%. If they say 8% plus what? 4%, 12%. 8% plus 4%, 12%. Capital employed will go up by 50 lakh. What is this 50 lakh? Extra debt, extra equity, extra preference, or combination of all the three extra. But 50 lakh extra has to come. If that is the scenario, 2 CR will go up to what? 2 crore 50 lakh. 2 CR will go up to 2 crore 50 lakh. And now we will earn 12% into 2 crore 50 lakh. We'll earn what? 12% into 2 crore. This percentage is wrong. 12.5. No? Can you just check? 25 on 200. Sorry about it. 25 on 200. 12.5. Sorry. 12.5 plus 4 is then 16.5. 16.5. And now we will earn 16.5 into 2 crore 50. 16.5 into what? 2 crore 50. What's the number you get? 41 lakh 25,000. This will be the start in that EBIT format. From there, deduct interest, which can be different for option. Get EBT, deduct tax, get EAT, deduct preference, which can be different. Get EAES, number of equity share, EPS, stop at EPS. R do P multiple, stop at MPS. R do number of equity share, stop at MB of equity. R do MB of firm, depending on what the question wants us to do. Any doubts in this? Understood till this? Can we proceed? Any doubts in this? Got clarity? Any doubts here? Let us see an example. Company earned EBIT of 23 lakh. EBIT of 23 lakh. Existing capital includes 10 lakh of debenture, 20 lakh of long-term loan, 20 lakh of reserves, 50 lakh of equity share capital. Can you tell me the total of all of this? 10 lakh of debenture, 20 lakh of long-term loan, 20 lakh of reserves, 50 lakh of equity share capital. How much? 1 crore. 1 crore. Listen. Listen. Today the EBIT is 23 lakh. Nothing for you to write. Capital employed is 1 crore. 23 by 1 crore is 23%. Then they are saying company plans to raise. How much is the new EBIT if ROI will improve by how much? 2%. ROI will improve by 2% means 23 plus 2, 25. 23 plus 2 is what? 20. Any doubts till this? And they are saying how much we are raising? 30 lakh to do what? Pay off debenture. If I return debenture, listen, what is the capital employed today? 1 crore. This will increase by 30 lakh, but also reduce by 20 lakh because you are repaying the debenture. Sorry, 10 lakh. It will also reduce by 10 lakh. Listen, what is capital employed? Debt plus equity plus preference. You are raising 30 lakh and repaying debentures worth 10 lakh. Repaying debentures worth 10 lakh. Repaying debentures worth 10 lakh. So capital employed will become 1 CR plus extra 30. Where is that extra 30? In what form? I don't know. What form? I don't know. Company wants to raise what? 30 lakh. Ideally, capital employed will go up by 30 lakh, but it is also used for what? Paying off the debenture. Paying off the debenture. Debenture value is how much? 10 lakh. Debenture value is 10 lakh. So listen, capital employed from 1 CR will go up by how much? And now this is 25% into 1 crore 20 lakh, which is how much? 30 lakh. Any doubts on this? Any doubts on this? Base concepts are almost ready. I'll be able to now move to question in some time. Any doubts on this? Understood till this? Got clarity? Can we proceed? Any doubts on this? Understood? Now, what should we try maximizing? That is, I told we can maximize EPS, we can maximize MPS, we can maximize market value of firm. Question says EPS, MPS, MV of firm. If question says maximize EPS, stop at EPS and tell which alternative maximum. Question says MPS, stop at MPS and say which is maximum. Question says MV of firm, do MV. Problem is silent. Problem is silent. Then depends on P multiple given or not given. Not given, stop with EPS. Given, go till the end part. Go till the end part. End part is what? Market value of firm. End part is market value of firm. Any doubts in this? My base is ready now. We'll be in a position to move to question. I'll just quickly discuss again one. The term capital means what? Long term money. Capital structure means composition of long term money, and we are trying to find which one is better, which combination is better. For doing that, marginal costing income statement start from sales, which we will not do. We'll start with EBIT, deduct interest, EBT, deduct tax, EAT, deduct preference dividend, EAES, number of equity, stop at EPS. P multiple there, maybe MPS, maybe MV of equity, maybe MV of firm, maybe MV of firm. Either it's EPS, MPS or MV of firm, mostly not MV of equity, mostly MV of firm. These are the steps we'll follow. We'll identify the alternative, calculate interest, PD, number of equity share, and identify the alternative which maximizes what? EPS or MPS or MV of firm. Important part is ROI after, sorry, EBIT after expansion is equal to new ROI into new capital employed. ROI copy paste. What is ROI formula? EBIT by capital employed, and the new capital employed is old capital employed plus any new capital raised, very rarely minus repaid. You can just add this minus capital repaid. What is repaid? Is paying off debenture. Capital repaid, very, very rare. I raise new money to buy back equity share. That is capital repaid. Minus capital repaid. And finally, this alternative. If question says EPS, go follow EPS. Question says MPS, follow MPS. Question says MV of firm, follow MV of firm. Silent, stop at EPS or stop at MV of firm. Any doubts in any of the concept? Clear? Can we proceed? Done. Base is ready now. Okay, now we move to the next concept, which is called indifference point. Let us understand this and then we go through some questions around it. Now listen. Indifference point. Tell me, what is the meaning of indifference point according to you? Same value, worth. So whenever there are two options, and if both the option are equally worthy, one is not better or the other one is not better, that is called indifference point. We have learned this in marginal costing, where we compare two alternative. Here, indifference point is the level of EBIT, is the level of EBIT where two plants give same EPS. There are two plants give same EPS. Now, how two plants can give same EPS? Let us take, we did this question in the previous session. I take these numbers. And take EBIT as X. EBIT is X. I start with EBIT as X. The same step you have to follow. Step 1, identify alternative. Step 2, compute interest, PD, number of equity share. But no need to compute EBIT. EBIT is X. EBT is X minus 175. X minus 175. I'm not very sure whether I'll get a indifference point here or not, but I've just taken the same number. Tax is 0.5 into X minus 175. 0.5 into X minus 175. This is 0.5 into X minus 175, and again 0.5 into x minus 175. We are just doing the same thing. PD, let's assume 225, 475. When you deduct this, you'll get 0.5x, 87,500 and 225. So much? 87,500, 220, 312, 312, 500. Other one, you please subtract it. 312, 500. Sorry, 0.5x minus 562, 500. Number of equity shares are this, let's assume. And EPS equal to, don't worry on the numbers part of it. Focus more on the concept part of it. This is the EPS for the first one. And the EPS for the second one is this. Now what I need to do is I will equate both of them. Equate means same. Somewhere I will solve it. I will get one answer for X. That is called indifference point. Indifference point is the level of EBIT at which two plans will give same earnings per share. You want to compare, there is a third alternative. Then 1 and 2, one indifference point. 1 and 3, another indifference point. 2 and 3, another indifference point. So when we compare this, when we are going to equate this, we equate this 0.5x minus 312, 500, 60,000, 0.5x 562, 500, 40,000. If you equate this, I cross multiply. When I do cross multiplication, 60,000 and 40,000 is cancelled. 60,000 and 40,000 is cancelled, and it becomes 0.5x minus 312, 500 divided by 1.5. 1.5 equal to 0.5x 562, 500. Please do cross multiplication, solve x. Solve this. Divided by 1.5. 60, 40 cancelled. 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 1.5 is multiplied other side. 0.75x minus 843, 750. 843, 750. 843 goes to the other side. 531, 250. 0.5 goes to the other side. And x is equal to how much? At 21,25,000. A 1 and 2 will give same earnings per share. 1 and 2 will give same earnings per share. Same earnings per share. Alternative 1 and alternative 2 will give us same earnings per share. Same earnings per share. This is basically the concept. The concept is very simple. We are trying to find when are we going to get same earnings per share. Same earnings per share. So what will we do? Indifference point, level of EBIT at which two plans will give same earnings per share. The above line I'll explain in some time. Identify plan. Compute interest, preference dividend, number of equity share. Assume EBIT as X. Get EPS in terms of X. Equate EPS of two plan and solve X, which is the indifference point. Solve X, which is the indifference point. Solve X, which is the indifference point. Any doubts till this? Understood? Okay. Now, let us take another example. I'll maybe change the numbers a little bit. There's another example where let's assume interest is 40,000, interest is 0. Okay. This is X minus 40,000. This is X. You get 0.5x minus 20,000, 0.5x. After subtraction, 0.5x minus 20,000, 0.5x, 0, 0. This has 0.5x minus 20,000, 0.5x. Number of shares is 10,000, 20,000, 10,000 and 20,000. 0.5x minus 20,000 divided by 10,000. Can you please solve this? Tell me the answer. Solve this and tell me the answer. Equate both, solve and tell me the answer. Equate both, solve. Solve this and let me know the answer. What's the answer you get? Sorry? Everyone has to tell me the answer. What is the answer you are getting? Equate both. Equate, guys. Please do the equate both. Max, you will have to do, guys. 80,000 it has to be. It has to be 80,000. It has to be 80,000. Now, just for our discussion sake, I'll do certain changes here. I write 80, 80. This will be 40, 80. Taxes 20, 40, 20, 40, 20, 40, 20 by 10 to 40 by 22. Okay, till this is fine. There's an allied term which is used here called financial break-even point. What is the meaning of term break-even point? What is the meaning of the term break-even point? You have seen break-even point. No profit, no loss. Financial break-even point is the level of EBIT at which EPS is 0. At which EPS is 0. I want EPS to be 0. Which will be 0 if? Which will be 0. What is financial BEPs? EBIT. Financial BEPs, EBIT should at least be equal to interest plus PD divided by 1 minus tax rate. Interest plus preference dividend divided by 1 minus tax rate. Listen, if my EBIT is 20 lakh, interest is 20 lakh, EBT 0, EAT 0, EAS 0, EPS 0. EBT 20 lakh, tax is 20% and preference dividend is 10 lakh. EBT has to be 20 lakh if preference dividend is 10 lakh, EBIT 20, no interest, EBT 20, after tax EAT 10, preference dividend 10, EAES 0. So I should at least earn what? Interest plus PD divided by 1 minus tax rate. Problem is preference dividend is not a tax deductible item. So in the first alternative, it is 40,000 interest, no preference dividend. If you earn 40,000, EPS will be 0. If you earn what? 40,000, EPS will be 0. EPS will be 0 if you earn how much? 40,000. Second alternative. How much is the interest in the second alternative? Keep participating. Preference dividend? 0. First alternative has BEP of 40,000. Second alternative has BEP of 0. Now concept is very simple. If my indifference point is 80,000, below indifference point, below indifference point, one is better. Above indifference point, the other one is better. Now what is better? How will I calculate? Instead of this 80,000, I repeat now 60,000. I don't want you to write anything. Listen. Can you tell me logically, or if I do 60,000, listen, if I do 60,000, one plan is going to be better. Then you do more than 80,000, other plan will be better. This is the concept. Concept is below indifference point, one is better. Above indifference point, the other plan is better. Below indifference point, one plan is better. Above indifference point, other plan is better. Now, which is better is below indifference point, low BP plan. Below indifference point, low BEP plan, which is plan 2. Above indifference point, high BP plan, plan 1. For example, if I do 60,000, I know alternative 2 will give a better earnings per share, will give a better earnings per share. Proof: minus 40, 0, EBT how much? 20, 60, taxes 10, 30, EAT 10, 30, no preference dividend, EAS 10, 30 divided by 10,000, 20,000, 1. Which is better now? Alternative 2. Alternative 2. At 80,000, which is better? Both are equal. At 80,000, both are equal. At 80,000, both are equal. Now I go ahead and add another 2 column. Add another 2 column here. This is for your understanding. Get full grip on the concept, and then we'll obviously do a lot of question. If I try 1 lakh, 1 lakh, is it more than the indifference point? 1 lakh, alternative 1 will give better EPS. I can do the calculation, but I'm sure about the answer. I'm sure about the answer. For example, minus 40, 0, 60, 1 lakh, 30, 50, 30, 50, 0, 0, 30, 50, 10, 20, 2.5, 3 and 2.5. Which is better EPS now? 1. At 80,000, what happened? Both are equal. Now, earlier segment when we were doing, we learned that an organization would want to maximize EPS. Mostly EPS, okay? Now, you told you want to maximize EPS, but the problem is financial break-even point or indifference point is saying always 1 is not better. Sometimes 1 is better, sometimes 2 is better, sometimes 3 is better, sometimes 4 could be better. So this approach says that we'll have to have little bit flexibility. What is flexibility? I will first evaluate the alternative. I will ask the managing director a very simple question. What is the likely EBIT? What is the likely EBIT? MD says EBIT is going to be 2 lakh rupees. I will say if it is going to be 2 lakh, please go for plan 1. Please go for plan 1. Please go for, I give a subjective answer. I'm not giving a straight answer saying that. I will put a table. What is the table we can put? Simple. If you have calculated indifference point, very simple table. Level of EBIT, level of EBIT, plan to be selected less than, or let's call 0 to 80, at 80, greater than 80. Below indifference point, low BP plan. Below indifference point, low break-even point plan. No, if you remember in marginal costing, below indifference point, lower fixed cost. Lower fixed cost means lower break-even point. Lower fixed cost means lower break-even point. So low BP plan, plan 2. At this plan 1 or plan 2, above plan 1, I will just give this table to my MD. Now managing director can decide which alternative is feasible for the company. As a finance professional, I can only, beyond EBIT, I can do my analysis. Till EBIT, MD, production team, sales team has to tell what will the business generate. Till EBIT is business generation. There I don't have a major say. So if you tell me EBIT will be 80,000, less than 80,000, greater than 80,000, I will give my answer. Any doubts till this? Understood? Can we proceed? Okay. Now, this is first part. If the planned EBIT is greater than indifference point, select plan with higher financial BP. Lower than indifference point, select plan with lower financial break even point. How will you calculate? Identify plan, compute interest, PD, number of equity share, assume EBIT is X, EPS in terms of X, equate. Okay. Now, one rare scenario can also happen. What is rare scenarios? When you try to equate, when you try to equate, you are not getting an answer for X. How is that possible? For example, EPS I got 0.5x minus 40,000 divided by 10,000. Okay. Another EPS I got 0.5x minus 60,000 divided by 10,000. Why we got and all, I don't know. 10, 10 cancel. 0.5 cancel. How will I get an answer? 10, 10 got cancelled. 0.5 will also get cancelled. And I'm not getting an answer for X, which will happen. Sometimes it will happen. Okay. Sometimes like this will happen. If this happens, it means one of the plan is always better than the other plan. One of the plans, that is called domination. What is domination is you are solving but not getting an answer. When you have indifference point, I am better sometime, you are also better sometime. When there is no indifference point, either I am always better than you or you are always better than me. So whether EBIT is like I gave a table, if there is a domination 0 to infinity, plan 1, that's all. 0 to infinite EBIT, only plan 1 is better. Only plan 1 or plan 2, whatever. Plan 1 or plan 2. So when I'm trying to solve, I'm not able to get an answer. I'm not able to get an answer. It means one plan is dominating the other plan, and who dominates is lower break even point is always better than higher break even point. Lower break even point is always better than what? Higher break even point. Lower break even point is always better than higher break even point. Clear? Any doubts till this? Understood? In your notebook, please write this example. Interest cost 20 lakh, equity shares, write the EBIT, right? EBIT XX, right? EBIT XX, EBIT XX, EBIT XX, write the example, EBIT XX, interest, EBIT is X and X. How much is the interest expense? Let's write 20 and how much you said? 20 and 30. I write in lakhs, 20 and 30. 20 and 30. EBT is how much? X minus 20, X minus 30, X minus 20 and X minus 30. EBT is X minus 20 and X minus 30. How much is the tax rate? EAT directly, okay. 0.5 X minus 10, half of the earlier number. Earnings after tax directly I am writing, okay. Half of the earlier number. 50% tax, 50% balance. 0.5x minus 10, 0.5x minus 15, minus 10, minus 15, minus 10, minus 15, minus 10, minus 15. Understood till this? Then EPS equal to, how many shares are there in the first company? EPS equal to first company 0.5x minus how much? 10 divided by how many shares you said? 10. Second company 0.5x minus how many shares? That's all. One time, two time, goes to the other side. Forty. X equal to 40. X equal to 40. 0.5x equal to 20. X equal to 40. Clear? Any doubts in this? Understood? Can we proceed? This is a very simple approach which we follow here. No new learning. Only thing is, do whatever you learnt earlier and just write EBIT as X. Just write EBIT as X. Able to understand this? There are good example. And financial break-even point, level of EBIT at which EPS is 0. Level of EBIT at which EPS is 0. Financial break-even point equal to interest plus PD divided by 1 minus tax rate. Interest plus PD divided by 1 minus tax rate. Nothing for you to write. Listen. Interest cost 20 lakh. 6 lakh divided by 1 minus 0.25. 6 lakh divided by 1 minus 0.25. 6 lakh divided by 1 minus 0.25. I get my financial break-even point. At financial break-even point, EPS is going to be 0. Neither positive nor negative. Neither positive nor negative. EPS can be negative also if you make losses. But here neither positive nor negative. Example 11. Tell me what should be the answer. Example 11. Let others also check. Example 11. Example 11. What is the indifference point? Are we below indifference point or above indifference point? Below indifference point. Which one is to be selected? I said lower break even point. Lower break even point. Lower break even point. Lower break even point. Where? Below indifference point. Below indifference point, which is what? Plan 2. There exists no indifference point between 2 and 3. No indifference point means one is dominating the other. One is dominating the other. No indifference point means when you solved, you are not able to get an answer. Financial BP of 2 is 20 lakh, 3 is 10 lakh. Which has better BP? Better BP. How is it saying 2? Which has better break even point? Guys, participate please. Which has better break even point? 3. Plan 3 has better break even point. It means plan 3 is always better than plan 2. Plan 2 EPS will be equal? No. Plan 2 EPS will always be higher? No. Plan 3 EPS will always be higher? Yes. Plan 3 is always better than plan 2. Plan 3 is always better than plan 2. So 2 new concepts I have done, and with this we are now going to get back to questions. Any doubts on this? Any doubts on this? Clear? Okay, I now move to the next set of concepts, which is on an area called capital structure theories. Now, initially in this chapter, we learned capital means long-term money, capital structure means composition, and we learned about an optimum capital structure. Optimum is one where you either maximize EPS or maximize MPS or maximize value of firm. Something around that we saw. Now, on the capital structure, there are certain theories which have been released by different people, and these theories have made certain conclusion. Some theory will say any capital structure is fine. Some theory will say no, this mix is fine. Some theory will say something else. So, is there any utility of the capital structure or not? We are going to learn here. Before we start this, one thing we need to be aware is there are certain common assumptions these theories have made. There are totally, I think, 4 or 5 theory. Every theory has certain assumption. First assumption is there are only 2 forms of capital. They are working only with debt and equity. The theories, no concept of preference. No concept of preference capital. Debt and equity are the only two forms of capital which is there. So when we are evaluating any capital structure theory, preference will not come. Second, whatever we earn will be paid as dividend. If you have made earning of 10 lakh, dividend is 10 lakh. No concept of flotation cost. What is flotation cost is when I'm trying to issue debt, equity, preference or not there, there will be some flotation cost. The theory said no, you cannot have flotation cost. KE greater than KD, that is in a single company, cost of equity will always be higher than cost of debt, which is logical. Reason is equity guys carry more risk, so there is a higher cost. Debt guys carry lower risk, there is a lower interest. Lower interest, dividends have to be on the higher side and your interest has to be on the lower side. The theory initially also made saying that no income tax. When these theories were released, they were released mostly 1920s type. So they made a conclusion saying income tax does not exist. Income tax does not exist. But then they found no, this is not workable. One theory made a change. Perpetual life. Perpetual life means there is no end to the company. Equity no end, company no end, going concern assumption. Business risk remains same. What is business risk is the risk related to the company's operation. Bharadwaj Institute faces multiple risks. What is the risk we face? Number of students in CA stream going down. Number of students itself going down, we will be affected. That's the first risk we carry. Second risk we may carry is our reputation in the market is going down. So maybe if that goes down, we will have an impact. Third risk, foundation students are not coming at inter are not coming at final. A lot of risks we face. They're saying whatever risk in our company face, that risk is not going to change. It remains same. If risk remains same, KE and KD should also remain same. What is KE is what does an equity shareholder want? If I invest in a risky company, I want higher KE, I want higher return. If I invest in a low risk company, I want lower KE, lower return. So whatever is the risk, irrespective of the capital structure. What is capital structure is we'll keep changing that. They're saying risk, the business side risk will remain same and total assets will remain same. Total asset remains same means if there is a company which wants to say that I want to raise debt, it means you're raising debt means you are replacing it with raise debt, buy back equity. Raise debt, buy back equity. No concept of adding on any extra debt or equity. If you're adding debt, it means you're reducing equity. If you're adding equity, it means you're reducing debt. These are common assumptions of the theory. Why this is critical? An exam question may ask, what are the assumptions of net income theory? First write these 8 and there are something extra I'll come to in later. Okay, only two forms of capital, debt and equity. Full earning equal to dividend, no concept of flotation cost, KE greater than KD, no income tax, perpetual life means there is no end, AC remote is there, just switch on this. No, perpetual life means there is no end to it and business risk remains same, Now then came the theory. Certain theories said whatever you are learning in this chapter is relevant. When I say what you are learning in this chapter, some theory said change capital structure, value will change or effect will be there. And some theory are called irrelevance model. What is irrelevance model is? In this case, whether the mix is 50-50, 100-0, 80-20, 0-100 doesn't matter, all are same. If somebody says irrelevance model is logical, entire chapter you can throw it out. No point in learning the chapter. Because as per irrelevance model, all theory, all capital structure will have same result. What are these? What happens? We will understand. Before even I go into it, let me take an example so that we understand better. Okay. I'll explain theories with this example. Particulars amount EBIT less interest. What do we get? EBT. What do we deduct after that? No tax in this theory. No tax in the theory. No tax in the theory. EBT is otherwise called what? EAT. After that, what do you deduct? No concept of preference dividend. EAES. That's the dividend. That is the dividend. This is what the theory has said. Okay. The theories have said no concept of income tax. One theory has made a revision. We'll see that later. Okay. No concept of income tax. No concept of preference dividend. No concept of retaining the money. Okay. This is first part. Okay. Nothing for you to look at in the book and all. Please be understand this. Let's assume EBIT is 10 lakh. Interest is 2 lakh. EBT is 8 lakh. EBT is 8 lakh. After that, cost of debt, cost of equity, cost of capital. Can you tell me what is the formula of cost of irredeemable debt? Irredeemable debt formula. You'll have to tell me. Interest after tax divided by net proceeds. Interest divided by value of debt. Interest divided by value of debt. No after tax. No after tax concept. Interest divided by value of debt. What is value of debt? I'll write in some time. Cost of equity formula. D1 by P naught. No plus growth and all. Money is not retained. Money is not retained. D1 is EBT. D1 is nothing but EBT. Earning before taxes. Earning after tax. Earning after taxes. EAES. EAES is dividend. Same dividend every year. No concept of D0, D1 and all because there's no change at all. Okay. Theory was very simplistic. Divided by value of equity. Divided by value of equity. Cost of capital. Tell me what is the formula for return on capital employed? Return on capital employed. EBIT by capital employed. EBIT by debt plus equity. EBIT by cost of capital, return on capital employed. Cost of capital. Okay. We'll write the numbers in some time. Then I have value of debt. Let's assume value of debt is 25 lakh. Okay. Value of equity. Just give me a minute. Value of equity 40 lakh. And we have value of firm. What is firm? Is debt plus equity, which is 65 lakh. Okay, this is a base number. Now, cost of debt is 2 lakh divided by 25 lakh into 100. Tell me the percentage. 8%. Clear? Cost of equity is 8 lakh divided by 40 lakh. 20%. Cost of capital is EBIT divided by this into 100. Okay, tell me the number. 3. Assuming a question gives you some information like this saying that EBIT is so much. Listen, the formula which you see here can be used in 3 ways. Cost of debt equal to interest by value of debt, or value of debt equal to interest by cost of debt, or interest equal to cost of debt into value of debt. Interest equal to cost of debt into value of debt. How we normally calculate interest? Debt into the interest rate. Debt into the interest rate. So listen, the 3 formulae which are very, very critical. The first formula I had is cost of debt equal to, what is the formula? Interest divided by, now first of all, this is not one formula, this is 3 formula. Value of debt equal to interest by cost of debt. Interest equal to cost of debt into value of debt. This is first formula, or 3 formulae, whatever way you want to call. Second formula we had is what? Cost of equity equal to what? EBT by, again this is 3 formulae. Again it is 3 formula. Again it is 3 formula. Clear? Third one, cost of capital equal to what? EBIT value of firm. Technically, it is value of firm, debt plus equity. Debt plus equity is called value of firm. Any of the formula can be interchanged and 9 things can happen. Now, this is the capital structure. Now I'm going to follow first approach called net income. What does net income do? We will understand. Now, this company says, I don't want 25 lakh debt. I want debt to become 35 lakh or 30 lakh. He's changing the debt figure. He's changing the debt figure. Net income will work in one approach. Net operating income will work in some other way. Okay. Net income, net operating income. These are opposite to each other. Okay. Net income and net original part, whether it's net income theory, net operating income. If question gives you some data and tell you calculate value of firm, original nothing to be applied. Any rework, the theory becomes critical. Okay. I am increasing this to 30 lakh. Okay. I'm increasing this to 30 lakh. If I increase this, indirectly equity will go down. But what happens in the workings, understand. Okay. 30 lakh is done. Now, I don't earn anything extra. I don't earn anything extra. EBIT will remain same because what is the concept said is, if you're adding debt, reducing equity. If you're adding equity, reducing debt. This is the concept says. Okay. Interest now is 30 lakh into 8%. 30 lakh into 8%. Interest is 30 lakh into 8%. What is the number? 2 lakh 40. This is 760. 760. Cost of debt is 240 divided by 30 lakh. You get what percentage? 8%. Now, net income theory has made one assumption. Net income theory says cost of equity will remain same. This is the assumption of the net income theory. Net operating income theory will work little differently. Okay. Once I do, both you will understand. But assumption is this 20 remains same. This 20 remains same. Now you may say, I want to change. No, you can't change it. The theory says it will remain same. This is the theory's conclusion. Now we can debate whether it is right or wrong and all, because in the practical world, if you borrow more, equity guys will get little worried. Cost of equity can change. But theory has said, net income said, cost of equity will remain same. Can you go down and tell me what is the formula for value of equity? Formula, tell me, value of equity formula. EBT by cost of equity 760 divided by 20%. 30 and value increases to 68, which means it's an excellent decision. Value of the firm is going up. Value of the firm is going up if you borrow more as per the theory. As per the theory, value of the firm is going up. Now, if you ask me which is better capital structure, second one is better. Second one is better than the first one. Net income theory, this is the conclusion. Okay. Comparison. You can do one more, two more, three more. Any rework you do, KE will be 20%. KE will be 20%. Any rework you do, any amount of rework you do. Going back, this becomes 10 lakh by 68 lakh. 10 lakh by 68 lakh into 100, obviously. 7-1. Any doubts till this? Clear? Okay, now listen. First line of the chapter would have said, minimize cost of capital, maximize value of firm. Minimize cost of capital, maximize value of firm. In this case, we have reduced the cost of capital. Both will happen. If one goes down, other one will go up. This is net income theory. Let us understand what net operating income is going to do. 10 lakh, copy paste. Same scenario. Okay, I'm just changing the same debt. Debt now becomes 30 lakh. 10 lakh, 2 lakh 40 into 8%. 7 lakh 60, 8%. Net operating income theory says, please copy paste this. 15.38. It has to be 15 point. What is to be copy pasted? Cost of capital. What is to be copy pasted is cost of capital. Cost of capital. What will happen to cost of equity? We'll understand in some time. What is copy pasted is what? Cost of capital. Same KO has to continue in the rework scenario. Same KO has to continue in the rework scenario. Now listen. Value of firm is 10 lakh divided by 15.38. Ignoring the rounding of difference, it has to be 65 lakh. Same value, same KO, same value. Ignoring the rounding of differences, okay? 65 lakh. Equity balancing figure. Equity balancing figure. What is balancing figure? 65 minus 30, 35 and wait. K is now 760 by 35 lakh. Tell me the percentage. 760 by 35 lakh. 21 points. This theory says. If you follow net operating income, whatever be the capital structure, value will be only 65 lakh. It is a irrelevance model. Irrelevance means no point in changing the capital. NO, net operating, no change in value. No change in value of firm. No change in value of firm. Other theories I'll discuss as we proceed. Net income theory says copy paste KE. Net operating income theory says copy paste KO. KD mostly will be same. Mostly will be same unless they give something else. Okay. So you see the conclusion here. Net income approach, KD constant, KE constant. Okay, KD constant, KE constant. KO will reduce if you increase debt in the calculation. In the percentages, you see here 30 became 25 became what? 30. KO has gone down. KO has gone. 30 becomes 35. KO will further go down. That's how the theory will work. That's how the theory will work. And value of the firm will increase. Value of the firm will increase. NOI, KD constant, KO constant, value of firm constant, and this will go up. This will go up with the increase in debt. This will go up with the increase in debt. This will go up with the increase in debt. I'll repeat again. Any rework we do, understand the theory. Original, I'm not bothered, okay? Any rework you do. If you are doing net income, copy, paste, KD leave it, okay? KD is mostly same unless they give different, okay? KD is not my worry itself, okay? Copy, paste. One thing which we are going to copy, paste is cost of equity. And one thing we are going to copy, paste is cost of capital. Any doubts till this? Clear? This can otherwise be also called as without tax. Both are same. Without tax also said the same thing. Without tax, but they gave a logic called arbitrage, which we'll understand as we proceed. So questions say follow approach without income tax. Do the same thing. Do the same thing. Without income tax, net operating income approach, both are same. Both are same. Any doubts till this? So if you see without tax, you will not see any difference in the words here. Without income tax, with income tax, what happens? We'll see. So NOI approach, approach without tax tells you are wasting time in this chapter. You're just wasting time in this chapter because according to this, whether it is 50% debt, 50% equity, 100% debt, 0% equity, 20% debt, 80% equity, everything will have same value of firm. If everything is same, how will I choose which is better? Everything is going to have same value of firm. Irrelevance means don't waste time in this chapter. Don't waste time in this chapter. No point in learning this. Understood till this? Clear? Okay. So we have understood net income, net operating income. Any doubts till this? Okay. There's another approach called traditional approach. Traditional approach. Give me a minute. Now, again, I'm increasing debt. Again, I'm increasing debt. 25 becoming. Traditional says, I don't know what will happen. You analyze. According to traditional, KD can also change. KE can also change. KO is balancing figure. What is KD can change? 8 can become 8.5. May become, may or may not become, I don't know. 8 can become 8.5 or may not also become also, okay. Original 20 can become 20.5, 21, anything can happen. 20.5 or 21, anything can happen. Question has to give. You can't do anything, okay. The question has to give. 8 became 8.5. 8 can remain 8 also. 20 can remain 20 also. R can go up also. Okay. 10 lakh remain same. 10 lakh remain same. Interest now is 30 lakh into what percentage? 8.5%. Calculate and tell me. Tell me the EBT EAT number. 7 lakh 45,000. Understood? Tell me value of equity. How will you calculate? Look at the formula. What is the formula for value of equity? EBT divided by cost of equity. EBT divided by cost of equity. 745 divided by how much? 20.5 percentage. 745 divided by 20.5. How much you are getting? 36. Firm is total. Firm is total. What is the total? 66. KO is balancing figure. KO is balancing figure. What is KO is? 10 lakh divided by 66. 34,146. 0. Any doubts till this? Now I will spend time again. I'll spend time again. First thing you need to be aware is this format. A bit less interest. Participate. A bit less interest is called what? EBT, EAT, EAES, dividend. Leave a line. What will happen? Cost of debt, cost of equity, cost of capital. Leave a line. Value of debt, value of equity, value of firm. Cost of debt equal to interest from the first three item, value of debt from the last three item. First three, second three, third three. Cost of equity, what is the formula? EBT divided by value of equity. Cost of capital, what's the formula? EBIT by value of firm. It's not 3 formula, it is 9 formula. When you follow net income approach, ignore as far as KD is concerned. I'm not really bothered about KD, okay? Understand KE, KO. I'm also not bothered about value of firm. Value of firm is KO inverse, okay? KE, KO be very clear. KE constant, KO reduces if you increase the debt. Which is constant alone, you understand. Other one is balancing figure, okay? KE is constant, KO is constant, KO is constant. This I don't know what will happen. This I don't know what will happen. You give me number, I'll follow. You don't give me number, I can't do anything. You give me number, I'll solve it. You're not giving me number, don't tell me to solve it. Don't tell me to solve it. So, if you follow net income approach, value of firm will change in the rework scenario. If you follow traditional approach, value of firm will change in the rework scenario. If you follow approach with tax, which I'm yet to discuss, value of the firm will change. If you follow net operating income approach, value of firm will remain same. A question will say, I'm doing buyback of equity with debt. Doesn't matter. Value of the firm is not going to change if you follow approach without tax. Approach without tax and net operating income approach. Now tell me, cost of equity is constant under which model? Participate. Cost of equity is constant under which model? Net income approach. Net income approach. Cost of capital is constant in which model? Net operating income approach or approach without tax. Net operating income, NO, no change in value of firm. NO, no change in value of firm. If somebody says no change in value of firm, it also means no change in cost of capital. No change in cost of capital. Clear? Any doubts on this? This is the format we do. A bit less interest, EBT, EAT, EAS, dividend, cost of debt, cost of equity, cost of capital, value of debt, value of equity, value of firm. Now, just for our understanding, quick understanding, cost of debt, you need not write anything. Cost of debt is how much? 8%. Cost of debt is 8%. Cost of equity is 14%. Debt is 10 lakh. Equity is 10 lakh. Together is 20 lakh. Okay, together is 20 lakh. Tell me, how will I calculate interest here? 10 lakh into 8%. Interest is equal to cost of debt into value of debt. How much is this? 80,000. How will you calculate dividend? EBT is equal to cost of equity into value of equity. How much is that? Reverse work, 2 lakh 20. 2 lakh 20 will give 11% in the end. Will give 11% in the end. There is no rework here. Rework means you'll have to tell me the theory name. Rework means you'll have to tell me the theory name. Please open this format and put it in this format. This is the data. Open the format. Just one practice. Let's do example 15. Write the format. Example 15. EBIT less interest, EBT. Only EBT is fine. Okay. Others are just for your understanding. Leave a line KD, KE, KO. Leave a line debt, equity and firm. Debt, equity and firm. Leave a line debt, equity and firm. Write the format. Be crystal clear on the format. Like we had those 3 steps. Next to 15 question, this format will be used. Next to 15 question, only this one format. Unless income tax is introduced, where I'll have to change slightly. You have written the format? Everyone written the format? Write the format. Particulars. Particulars, and this is the format. Example 6, I think, whatever number. Example 15, sorry. Tell me what is the EBIT in this example. 5 lakh. Let us write the data. 5 lakh. 10% means cost of debt is 10%. 10% is cost of debt is 10%. What is the value of debt? 20 lakh. Cost of equity? I am not bothered what extra information is there. My objective would be to fill the entire table. Once I fill the entire table, it will answer whatever is asked in the question. Can you tell me how will I calculate interest? Value of debt into cost of debt. Two lakhs. Clear? How will we get EBT? 3 lakh. With EBT and KE. With EBT and KE. With EBT and KE. What will you get? Value of equity. With the EBT and cost of equity. 3 lakh divided by what? 15%. Firm is, and cost of capital is 5 lakh, 540 lakh. How much? 12 point. For you over, that's all. Rework is there, then we'll have to see the theory name. Any doubts on this? Understood? Can we proceed? Any doubts? Example 16. Example 16. Let us put it in the same format. When I say same format, I don't know. I should have told this. If you have space, add an extra column. If you have space, you don't have a space, then write again. Example 16. Example 16. Whatever is possible for us to fill, we'll fill it. Not possible for us to fill, leave it. That's okay. Can we start? What is this EAES in this table called? EBT is how much? 30 lakh. What else is there? 15%. Debt outstanding is? What have they asked in the question? Value of firm. Okay, value of firm. Clear? Can we calculate interest? No, I don't need it because I'll not be able to do interest part analysis. And I think they have not asked that in the question. What can you calculate now? Value of equity. What's the formula? 30 lakh divided by 15%. How much? And value of firm is 3 over, that's all. 3 crore 50 lakh. Other parts not possible in this question. Not possible, and they haven't asked also. Any doubts? Understood? Can we proceed? Clear? Example 17. Put it in the same format. Put it in the same format. Operating income means EBIT. Put it in the same format. Example 17. I keep extending it. This example we'll do and then we go to descriptive question. Example 17. EBIT is given 9 lakh. EBIT 9 lakh. What else is there in the example? Cost of debt is 10%. Then cost of capital is 12%. Value of debt is, automatically the format will give the answer. Don't try anything new here. Nothing to be tried, attempted. Put it in the format, it will give you the answer. How will I calculate interest? 30 lakh into 10%. EBT is 6 lakh. EBT is 6 lakh. What else can we calculate now? Value of firm. Let's first do value of firm. Value of firm is EBIT divided by cost of capital. EBIT by cost of capital. How much you get? 75 lakh. Value of equity, balancing figure. $45 lakhs. Cost of equity, balancing figure. 6 lakh divided by what? Clear? Any doubts in this? Understood? Done? I'll not attempt any extra examples if there. Some more examples are there. All that is fine. Okay. This is without income tax part is done. With income tax needs some more discussion. We'll see that later. Now let us bring the approach with income tax. Approach with income tax. Be in listen mode. Initial explanation is very, very critical. Once you get the hang of the initial explanation, thereafter it is pretty much the same thing. Okay. Let me go back to the format which we follow. Let us go back to the format we follow. What the first item we write in the format? EBIT, then less interest, then EBT. We had a lot of other names. I'll come back. I'll be making some changes. Cost of debt, cost of equity, cost of capital, value of debt, value of equity, value of firm. This is the format we have been using. Okay. In this format, we used to calculate three formulae. First formula was cost of debt. What is the formula for cost of debt? Interest by value of debt. Okay. Then we had cost of equity, which was EBT by value of equity. Then we had cost of capital, which is EBIT by value of firm. Clear? Okay. With income tax, only few things I'll change. And then there are certain other concepts. Tax, less tax, EAT, less tax EAT here into 1 minus T. 1 minus T is tax rate into 1 minus T tax rate into 1 minus T, or you can call it as EAT. You can call it as EAT into 1 minus T into 1 minus T. Let us take some numbers. EBIT 10 lakh. No interest for the time being. EBT is 10 lakh. Tax is 30%. 3 lakh. EAT 7 lakh. EAT 7 lakh. Debt is not there in the company. Equity is 35 lakh. Firm is also 35 lakh. Firm is also 35 lakh. Cost of debt not applicable. What's the formula for cost of equity? EBT into 1 minus tax rate by value of equity. EBT is 10.7 divided by 35. 10 into 0.7 divided by 35. Debt is not there in the company as of now. What's the answer you got? 20%. Cost of capital, same logic. 10 into what? 0.7 EBIT into 1 minus tax rate, value of firm, because anyway debt is not there, equity and KO is same. Okay. Now format is this: EBIT less interest, EBT less tax, EAT, EAS dividend, cost of debt, cost of equity, cost of capital, value of debt, value of equity, value of firm, cost of debt, interest into 1 minus tax rate by value of debt, cost of equity, EBT into 1 minus tax rate by value of equity, cost of capital, EBIT into 1 minus tax rate by value of firm. Any doubts till this? Okay. Now there are two companies, same company. This company is called unlevered. Unlevered means debt is not there. Unlevered means without borrowing. Unlevered means without borrowing. Suddenly, this company is saying, I will become levered. Suddenly, the company is saying, I will become levered. Levered means I will borrow money. I'll borrow money. What is the amount they are borrowing? 5 lakh. Amount they are borrowing is 5 lakh. Amount they are borrowing is 5 lakh. This is what the question says. And cost of debt is 7%. What is 7%? Is 10 into 1 minus tax rate. It effectively is 7%. Interest rate is 10%. Effectively 7%. Interest rate is 10%. Effectively is 7%. Now, if the company earns 10 lakh EBIT, earlier it had to pay income tax of 3 lakh. Now, if it earns 10 lakh EBIT, it will pay some interest. Is interest allowed as deduction for income tax purpose? Participate. Can I subtract the interest in the taxable profit? Yes. So, interest or debt has one advantage called tax benefit. Interest or your debt. Debt has an advantage. For example, 10 lakh, 5 lakh into 10% is the interest. 10% is the interest rate. After taxes 7. After taxes 7. So I'll pay 50,000. 950. 950 into 30% is how much? And EAT 6 lakh. Now, one good thing which has happened is, let's assume I am the owner of the company. Okay. Here I got 7 lakh. I am now the owner of the debt and equity. I am the owner only. I am the owner. I got 665 and I also got this 50. I also got this 50 just because now it is debt and equity. I get 7 lakh 15. When it is only equity, I get only 7 lakh. I am the owner, okay? I only gave debt, I only gave equity. I only gave debt, I only gave equity. One situation I'm getting paid 7 lakh. Another situation I'm getting paid 7 lakh 15. This interest, I don't pay any tax slab rate. I'm within the slab. I also don't pay any tax to the government. So this looks very illogical then, because when I'm unlevered, government is collecting more money from me. When I'm levered, government is collecting less money from me. And I'm also not paying any tax on this interest because it is within my slab income and all. So then everybody would want to become a levered company. Levered has one benefit. Unlevered, levered. When we did net operating income approach or approach without taxes, whether it is 100% equity, 80% equity, 20% debt, 60%, all are same value. All are same value. When income tax was brought in, Modigliani Miller said, no, no, no. Value of the levered firm. Levered means one who have debt will be value of unlevered. Unlevered means that one which we did plus extra benefit due to the tax. Extra benefit due to the tax. If it's without tax, value of levered equal to value of unlevered as per approach. Approach all same value. Approach all same value, whether you are borrowing, no borrowing, 10% borrowing, 20%. Approach, net income approach, all are same. Approach and net income approach all are same. Then what has to happen? Here my values, listen, 35 lakh unlevered plus 5 lakh into 30% extra value. 5 lakh into 30% what? Extra value. 5 lakh into 30%. More tax, more benefit. More tax, more benefit. Why? Because interest I pay, I reduce tax outflow. I reduce tax outflow. So value now is 3650. Equity balancing figure 3150. Cost of equity is equal to EBT into 1 minus tax rate divided by value of equity. I'm repeating again. Listen, nothing to calculate. I'll tell you when I need the number, okay? EBT into what? 1 minus tax rate by value of equity. EBIT into 1 minus tax rate value of firm. If it was without taxes, KO would have remained the same, value of firm would have remained same. KO would have remained the same, value of firm would have remained same. Now also said the same thing. Only thing he is adding is, if you borrow, income tax guys are giving you benefit, because of which valuation can be little better. Valuation can be little better, not fully better, but some benefit is there. Some benefit is there. Some benefit is there. So under with the taxes, neither KE will remain same nor KO will remain same. Neither KE will remain same nor what? KO will remain same. With the taxes. With taxes. Which one should I solve first? First you have to do without debt, unlevered company. In a question you have to find an unlevered company, do its full working. After that is done, value of levered firm is equal to what? Value of unlevered firm plus amount of debt into tax rate, plus amount of debt into tax rate. Now tell me what is the KE number? 950 into 0.7 by 3150. 21 point. And tell me KO number. 19 point. Any doubts on this? Any doubts on this? Okay, question doesn't end here. I go ahead. Amount levered. 10 lakh story remains same. 10 lakh story remains same. 7% story remains same. Debt I make 15 lakh. Debt I make 15 lakh. No problem. Go back to the first one. Original. What is original? The unlevered one. Original is unlevered one. Don't try to look at the 10% debt, 20% debt. None of them. Original unlevered. What is the value of the unlevered company? 35 lakh plus what? 15 lakh into 0.30%. Tell me the value. 3950. Balancing figure 2450. Interest payment 15 lakh into 10%, 150. We get now what? 850. 850 into 30% is 255. Balancing figure or whatever EAT is how much? 595. We come back here. 850 into 0.7 divided by 2450. 2450. How much you are getting? Guys, participate. 24.29. And this one 10 lakh into 0.7 divided by 3950. 3950. How much? Any doubts in this? Clear? I'll repeat the concept one more time. Arrive at the value of unlevered firm, company with no debt. Value of levered firm is equal to value of unlevered firm plus amount of debt into tax rate. One exam, what they did is they said we are a 100% equity company. We are going to do buyback. In a buyback, what will happen is equity will become debt. So unlevered will become levered. Equity will become debt. Unlevered will become levered. Unlevered will become levered. Put it in the table. First unlevered company, levered company, value of unlevered company plus amount of debt into tax rate. Some question, only value will be asked. Don't do the table again. Only value means just give the answer. With the value they want KE, KO and all, do it in the table. With unlevered, only table. Unlevered has to be in the table. Unlevered has to be in the table. Can be done without table also, but I prefer to do it in the table. Levered one, only value asked, apply formula. Value, KE, KO, all asked, please do it in the table. After the table is done, write separate summary. Write separate summary. Wait. So I was saying about this, no? All equity financed company considering replacing equity with debenture. So all equity is unlevered. After replacement, it will become levered. I'm not doing the answer and all. I'm just telling you this is a type of a question which can come in exam. Any doubts on this concept? Understood? Okay, this also I think we have used it, but let us see relationship between cost of equity, cost of capital of two similar firm. Two similar firm means two same companies. It could be company A and company B are identical. Identical. I did company A calculation. Now I want to do company B calculation. If it's net income approach, KE can be copy pasted. If it's net income approach, what? KE can be copy pasted. NOI approach, KO can be copy pasted. Traditional approach, nothing can be copy pasted. Nothing can be. Is this a new concept? No, already done. I've repeated here. I've repeated here. Two companies, either KE can be copy pasted or KO can be copy pasted or none of them can be copy pasted. Any doubts on this? I'll repeat one more time. In our format, add less tax, bring EAT, EAES dividend, less tax and EAT, EAES, no EAES dividend and all. In the formula, cost of debt equal to what? Interest into 1 minus tax rate. Cost of equity, EBT into 1 minus tax rate. Cost of capital, EBIT into 1 minus tax rate. Understood? Clear? Can we proceed? Okay, last segment of the chapter is on an area called arbitrage. This concept, parallelly questions will be done. One step I'll explain and we'll do parallelly the question. This is relatively a tougher concept for people to understand. Okay, what is arbitrage? Let's first understand. Arbitrage means making profits or extraordinary profits without taking risk. Now, in the practical world, if anybody wants to make any amount of money, he has to take risk. For example, Bharadwaj Institute is conducting classes for you. We are earning money, but there is a risk also. What is the risk? If we don't get the students, we'll not be able to recover even our fixed cost. I run a business, business has its own set of risk. I run a restaurant, risk is there. Without risk, making very high profit is not possible. A classic example, let us assume there's a product 1, there's a market A, there's a market B. In this place it is 10 rupees, in this place it is 15 rupees, and they are very nearby. Both the market has unlimited demand, unlimited supply. What I will do if I find this, I'll buy from market A, sell it in market B. Buy in market A, sell in market B, no income tax, let's assume, no GST, nothing is there, no transportation cost. Buy, sell, buy, sell, buy, sell, make you unlimited demand, unlimited supply is there. If this happens in the practical world, people are buying here, people are selling here. Economics say if you keep buying, price will go up. Price will go up. If you keep buying at one place, price will ultimately go up. And if you keep selling, price will ultimately go down. In the end, both have to become equal. This is the broad concept. Broad concept is making profits without any major risk, without any major risk. Now, this is given by Modigliani Miller. Approach said that two companies, when there are two companies, levered, unlevered, that is with debt, without tax, both the company had same value. Without tax, both the company had same value. He says this has to be true if the values are different. If the values are different, it will throw up arbitrage opportunity. It will throw up arbitrage opportunity. NOI theory said same KO, same value of firm. Also said same KO, same value of firm, but he gave a logic for that. That logic is called arbitrage. That logic is called arbitrage, making extraordinary profits without increase in risk. He said there are two types of arbitrage. One is called primary arbitrage. Second is called reverse arbitrage. We have two types of company. When we did with the taxes, which company has higher value, levered or unlevered? You'll have to keep participating. With the taxes, which has higher value? With the tax, which company will have higher value? Levered company or unlevered company? Levered company. So primary, it is without tax only. Primary arbitrage means levered more than unlevered. Reverse arbitrage means unlevered more than levered. There are two tests. What are these tests? You will understand as we proceed. Now, steps in case of primary arbitrage, steps in case of reverse arbitrage. First step is same in both. Compute value of two firms. What is value of two firms? Is EBIT less interest, EBT, leave a line, KD, KE, KO, leave a line, value of debt, value of equity, value of firm. After that, what happens? What happens in the steps? We'll understand as we proceed. Let us come to the question also here. Question 32. Ignore the heading. There are two firms N and M having same EBIT. M is a levered company having debt of 1 lakh, cost of equity of N, M. Find out how arbitrage process will be carried on. Ideally, when I do valuation of the two company, is there any tax information here? Okay, friends, please participate with me. Is there any tax information? You will have to be louder. I can't hear otherwise. Is there any tax information? No. Ideally, both should have same value. Which has debt in this case? M. Ideally, M and N should have same value. If M has higher value, it is called primary arbitrage. If N has higher value, it is called reverse arbitrage. Working note 1, valuation of two firms. Valuation of two firms. Valuation of two firms. Particulars Firm N unlevered, firm M levered. N unlevered, M is levered. Let us do the valuation, which is nothing but EBIT less interest, EBT, cost of debt, cost of equity, cost of capital, value of debt, value of equity, value of firm. EBIT less interest, EBT, leave a line, cost of debt, cost of equity, cost of capital, value of debt, value of equity, and value of firm. Clear? What is the EBIT given in the question? Keep participating with me, please. 20,000. N is unlevered, zero interest. M is levered, 20 and 13,000. 20,000, 13,000. Not applicable, 7%. Cost of equity is given in the question, 10%, and firm capital will come in sometime, 0, 1 lakh. EBT by cost of equity. EBT by cost of equity. Cost of capital is balancing figure. Any doubts on this? Understood? Clear? Any doubts on this part? Clear? Can we proceed? Any doubts on this? Got clarity? Can we proceed? Any doubts here? Done? Which company has higher value? Levered, unlevered? Levered. Now below, right? Primary arbitrage exists. Primary arbitrage exists as the value of levered firm is higher than value of unlevered firm. Step 2. Can we proceed? Steps are very simple. What is arbitrages? Let us assume I am a shareholder in this company, higher value company. Ideally, the value of the two companies should be in between 205 or 206 something. Okay. I am in the high value company. I will sell my shares. shift to the low value company and earn better profits, earn better. See, I am an investor in firm M. Somewhere I feel this market, they're overvaluing the product. One market, they're undervaluing. So what we will try to do is sell here, buy here, and make profit. Sell, continuously buy. In the end, both the prices will match or both the values will match. This is what arbitrage is. Sell at 15, buy at 10, sell at 15, buy at 10, sell at 15, buy at 10, sell at one place, buy at one place, sell at one place, and buy at one place. Step 2, compute present earnings of the investor. Compute present earnings of the investor by assuming, see, some question will give something like this. They will say you are holding 15% in levered company, 15% in levered company, or they may mention 15% in unlevered company, 15% in levered company, or 15% in unlevered company, or they do not mention anything. Concept says compute present earnings by assuming any percentage. I can assume by assuming 10% investment in equity of the company having higher value. Equity of the company having higher value. Question itself will tell 15% in this company or 20%. That's what they'll normally mention. If they don't mention, we take some percentage. Particulars, calculation amount. One by one I'll do. It is little bit unique. Calculation amount. Tell me which company has higher value. Keep participating. Company M. How much is the value of equity of that company? Right. Value of equity of firm N. Firm N 1,13,043. Value of equity of firm N 113,043. Our investment, we are investing 10% of 113,043, 11,304. I am a 10% shareholder in that company. Now what I am going to do is I will sell there, come here, earn more. Earn more is the logic here. Okay, I am already holding 10% of this. This company today pays dividends of 13,000. EBT is dividend. In that 13,000, I earn 10%. In that 13,000, I am the shareholder owning how much percentage? 10% of the equity of the company having higher value. So total dividends of firm N, dividends is EBT here, 13,000. Our income, we are 10% shareholder, 1,300. Our income is 1,300. Our income is 1,300. Clear? Now from there, we are going to shift to some other place. From there, we are going to shift to some other place. Clear? Step 3. Sell shares in firm N, buy shares in firm M. Sell shares in firm N, buy shares in firm M. Whichever company had higher value, sell the shares there and buy the shares of the other company. Sell shares and buy shares. Again, particulars calculation amount. We are done till step 2. I'll show you the step 2 in the concept book. Compute present earnings by assuming 10% investment in equity of company having higher value. 10%, 15, 20, anything is fine, okay? Now, does firm M have borrowing? Participate. Keep participating. Does firm M have borrowing? Does firm N have borrowing? No. So I was earlier invested in a company have borrowing. Now I shift to a company which does not have borrowing. So the MM said that, Modigliani Miller said that you sell shares, get money, but the second company doesn't have a borrowing. Second company doesn't have a borrowing, but you need a borrowing. You also need a because first company when you invested, you had borrowing and equity. Second company also should have borrowing and equity, then only they are comparable. One company borrowing equity, second company also has borrowing and equity, then they are comparable. If one has borrowing and equity, second one doesn't have borrowing, then they are technically not comparable. So what he said now, right? Sell shares and get 11,304. Sell shares and get 11,304. Or sell shares of firm N. I'll get 11,304. I'll get 11,304. Okay, I got this money. I'm going to invest in the first company. I'm going to invest in the first company. But MM said, there's a doubt. Firm M is the company having higher value? No, no. Okay, so I wrote wrongly. Okay, okay. Value of firm of. Okay, please change the words here. Please change. This is firm M. Firm M. Sell shares in firm M. I'll use the word levered, unlevered. I don't want to use the M and N. Okay, I'll use the word levered, unlevered. 113 our investment. Okay, 11,304. Okay, let me use the word levered and I don't want to use the word M and N. The levered company has borrowing. Unlevered company does not have borrowing. The levered company has borrowing. Unlevered company does not have borrowing. We are shifting from one company to another company. I want the unlevered company also to have borrowing. I want the unlevered company also to have borrowing so that they are comparable. How do I get them to have borrowing? That company will not have borrowing. Concept says you personally borrow money. You personally borrow money. Borrow money at the rate of borrow money at the rate of 7% interest. Borrow money at the rate of 7% interest. Borrow money at the rate of 7% interest. What is the 7% interest? The borrowing rate. How much do we borrow is also little critical. Listen, earlier other company had 113,043 equity. I had 11,304 in that. Other company has debt of 1 lakh. Proportionately, I'll borrow. I'm again talking about the company having higher value or company which is having borrowing. Their equity 113 minus 11,304. Debt 1 lakh. I want this debt 1 lakh to come in the second company also. They are having no borrowing. So personally borrow proportionate amount. Personally borrow proportionate amount. If 113 is equal to 11,304, cross multiply and tell me how much is 1 lakh. Has to be 10,000. has to be 10,000. Rounding of difference is okay. Okay, has to be 10,000. Once I do the step, I'll again repeat the step. I'll again repeat. First, we do the valuation. After the valuation is done, we are invested in the company having higher value. Keep participating with me. We are assuming investment in the company having what? Higher. Everyone has to say, I'll have to hear it, please, guys. Investment, it's a very dull topic otherwise. Investment in the company having what? Higher value. What is the higher value? 1,13,043. Our investment is how much? 10%, which is 11,304. What are the dividends of that company? 13,000. In that 13,000, our income is 1,300. Now I'm moving from a levered company to an unlevered company. When I make this movement, I want the unlevered company also to have borrowing. They do not have borrowing. Let us personally borrow money. Let us personally borrow money. Moment you personally borrow money, you will have personal interest expense. Corporate interest expense will not be there. Total money available. Total money available 21,304. 21,304. 21,304. Clear? Purchase equity of firm N. Amount I'm not writing, just purchase equity, right? Any doubts till this? Any doubts till this? 4. Compute new earnings. Once the step is done, I'll explain it again from the beginning. Compute new earnings. Compute new earnings. Particulars. Full money invested. Exact 10% stake. Exact 10% stake. Full money invested. Exact 10% stake. Value of equity of firm. What is the other firm name? Firm N. Value of equity of firm N. Value of equity of firm N. Tell me the value of equity. Our investment. Our investment. Our investment. There are two ways to solve the question. Once I'm done, I'll explain it fully again. Our investment 21,304. That's the money I have in hand. Or I again buy only 10%. I again buy only 10%. I again buy only 10%. Dividends EBT of firm N. Dividends are EBT of firm N. Look at the table and tell me. Dividends are EBT of firm N. 20,000. Our income. Our income 20,000 is for 2 lakh of investment. If somebody invests 2 lakh, they'll get 20,000. If somebody invests 2 lakh, they'll get 20,000. Or you can say 20,000. 20,000 into 21,304 by 2 lakh. And other side 20,000 into 20,000 by 2 lakh. 20,000 into 21,304 by 2 lakh. 20,000 is the dividend paid for 2 lakh of investment. We did 21,304. Tell me what is the dividend? 2130.4. Other side. Less interest paid. We borrowed some money. We borrowed. Once this is done, I'll explain again. Less interest paid. Interest paid. 10,000 we borrowed at what rate? 7%. Net income. Net income. Net income. Increase in income. Increase in income. Increase in income. How much was our earlier income? First step, we'll have the income. 1,000 minus 1,300. 130.4. No increase other side. Surplus money. Surplus money. Surplus money. In step 3, I had 21,304. Out of this 20,000 we invested. Surplus is 1,304. No surplus this side. No surplus this side. I'll explain this now. Let me first close this calculation fully. Close the computation fully. 1,304. You write till this. I'll explain from the beginning. Then only you'll get grip on this. 1,304 0. Written till this. Now listen. Concept, let's understand. First, this step I don't see any confusion. Okay. This step you do the valuation. You will have to sell the higher value company, buy the lower value company. Now, if I am a shareholder here and earning 1,300 and there's a similar company which gives me 1,400, why will somebody buy that 1,300 company? Similar company, both are same. They are saying TCS, Infosys, they are identical companies in the practical world. If the companies are identical, their value should also be identical. Value should also be identical. This is first step. After this is done, whichever has higher value, invest 10% on this. Invest 10% on this. Earn 10% of this. Invest 10%, 10, 20, 15, 30, your wish. Okay. I invested. Now, from this company, we are moving to the other company. From the yellow shaded one, I am moving to the green shaded one. Yellow shaded one is the company where I am invested today, and I am now making a move to the green shaded one. Yellow one is bad company, green is a good company. Reason is simple. Both are same. Why is yellow getting higher value? So what are we doing? We are selling here. Once I sold here, I got 11,304. I was checking if this has borrowing. It did not have borrowing. So I personally borrowed money. Got another 10,000. Put together, if I invest full money, I will earn more. Arbitrage has two checks. Invest full money. What is full money? 11,304 plus 10,000, 21,304, and earn 20,000 into 21,304 upon 2 lakh. Earn what? 20,000 into 21,304 upon 2 lakh. This is earning interest pay. Your earning will go up. Or you have invested 10% in this company. Please invest only 10% of this also and earn 10% of this money. When you earn 10%, you get 2000. You pay interest of 700. Income remains same. Some money is still there. Invest that somewhere else and earn extra. Invest that somewhere else. Somewhere else. That surplus money is there, no? You can invest it anywhere. So concept says higher earnings with same investment. Same investment is 21,304. Full investment, put it. Your 11,304. Borrow 10,000. Invest fully and do what? Higher earning. Or same earning with lower investment means don't put the full money, keep some money with you. There will be surplus cash. Compute value of 2 firm, compute present earning, assume 10% investment, sell shares, borrow, invest in other company, compute new earnings. Gain is confirmed if you get higher earnings or same earnings with surplus cash. I'll repeat again. Value the two companies. When you do valuation, one will have higher value, one will have lower value. You have to assume you have invested in the company having what? Higher value. Sell it share, move to the other company. In the other company also I want borrowing. They do not have borrowing. I will personally borrow money. Take the money additional. Full money invest, earn more than 1,300. Exact 10% stake you get, earn only 1,300 but have surplus money. Any doubts on this? Understood? I will then move to reverse arbitrage. Any doubts first on primary arbitrage? Clear? Understood? The second type of arbitrage is reverse arbitrage, where listen, compute value, compute present earnings, sell the shares. Only thing is in this case, we are invested in unlevered company and we are moving to a levered company. Earlier we moved from levered to unlevered. This had debt. I also wanted a debt in the unlevered company, which is not possible. So we borrowed money at the personal end. Unlevered doesn't have debt. Levered has debt. I want that company to remove the debt. That is not possible. So what concept says is, you move to the other company, buy equity shares as well the debt of the other company. Buy equity shares as well what? Debt of the other company and earn interest income. There you are paying interest. What does this do? If the other company is not ready to remove borrowing, let them have borrowing. I from my side will also invest in this borrowing. So one place they have a borrowing, second place I have an investment in borrowing, both will cancel each other. Is the concept. Both have to. I want them to remove borrowing. If they remove borrowing, great. If they don't remove borrowing, let me create a personal opposite of borrowing. Let me create a personal opposite of borrowing is investment in borrowing. Opposite of borrowing is, see, earlier situation we moved to levered to unlevered. I want unlevered company to have a borrowing. They are not ready to have a borrowing. I had a borrowing at my end. When I move from unlevered to levered, I want this company to remove borrowing. If they cannot remove borrowing, at my personal end, let me do reverse of borrowing. What is reverse of borrowing is invest in debt. Which company? That company itself. Invest in debt. How does this reverses? See, what is debt? Debt means whenever profits are earned and if you have a borrowing, if profits go down, you still have to pay interest. So borrowing is generally considered to be less risky and equity is considered to be high risky. So this company which has levered, if they have a borrowing, I have a problem. I wanted them to remove it. They are not ready to remove it. So what I do at my personal end is let them have a borrowing. I will also invest in their borrowing. So for them it's interest expense. For me it's interest income. Both offset each other. Both cancel each other. Both cancel each other. So sell shares, invest in debt, equity, calculate new earnings. Gain is confirmed if earnings go up or if there is a surplus cash Let us validate this with one example, and we'll do one more example later. Let's come to 33. Step 1 remains same. Please calculate the value of two companies. Calculate value of two companies. Question 33. Question 33. Working note 1. Valuation of two firms. Valuation of two firms. I'll not use the word M and N. It was just confusing last time. Let me use the word levered, unlevered. Headings are levered, unlevered. Levered, unlevered. Value both the companies. Once you're done, please confirm if these numbers are fine. Value both the companies. Once you're done, please confirm if the values are correct. Ideally, the levered will have lower value, unlevered will have higher value. That is called reverse arbitrage. If you are done, please confirm me the values you see in the screen. Are you getting these numbers? Can we proceed? Any doubts on this? Can we proceed? Everyone done? Can we clear? This is relatively even easier. Reverse arbitrage exists as value of unlevered firm is higher than value of levered firm. Unlevered firm is more, as the value of unlevered firm is higher than value of levered firm. Unlevered is more than levered. Reverse arbitrage exists. Clear? Can we proceed? Working note 2. Assume, have they given any investment percentage? Assume 10% investment in equity of company having higher value and calculate present earnings. Calculate present earnings. Same step was earlier also. Which company has higher value? Value of equity of unlevered company. Obviously, you'll have to write M and N. I don't want to write because it confused me last time. Here I'm writing without the name. Unlevered company. Value of equity of unlevered company. How much? 2 lakh, no? 2 lakh. Our investment in percent into 2 lakh. Our investment in percent. It is very uh, the steps are simple, but it is little unique. 10% into 2 lakh. 10% into 2 lakh. EBT in bracket dividends. Dividends of unlevered company. Of unlevered company. How much is the dividend of unlevered company? Our income. Thousand. Our income 2000. Our income 2000. Clear? Any doubts till this? Sell shares and move to other company and calculate new earning. I'm closing that in the step itself. Particulars and true column. I can do step 3 and step 4, but I'm doing it in the same step. Particulars. Full money invested. Exact 10% stake. Full money invested. Exact 10% stake. Exact 10% stake. Exact 10% stake. Now listen. Listen for 2 minutes. Investment in equity of levered company. Investment in debt of levered company. Both you have to invest. One place you earn dividend, one place you earn interest. How much money we have in hand as of now? Exact 20,000. I'll sell it and get 20,000. You can invest 20,000 in the proportion of 1 lakh is to 72,222. Or you can do 72,222 into 10%, 1 lakh into 10%. 1 lakh into only 10%. 10% in equity, 10% in debt. Wait for some time. Exact 10% means 72,222 into 10%, 7,222, 1 lakh into 10%, 10,000. Dividend income. The other company had a dividend of 13,000. I earned 10% of that. Interest income. Other company had interest expense of 7,000. I earned 10% of that. 700. Total income is 2,000. Exact 10% I buy. 72,222 into 10% I invest in the other company. 1 lakh into 10% I invest in debt. Dividends I earn 10%. Interest I earn 10%. Income I get same 2,000. And I have surplus cash. What is surplus cash is? I had 20,000. I invested 7,222, 10,000. Leftover money 2,778. Okay. Other option is I am going to invest my 20,000 money. I'm going to invest 20,000 money. So listen for some time. I am going to invest my 20,000 money in 72,222, 172,222 proportion. 72,222, 172,222 proportion. Same way, 1 lakh and 172,222. Can you give me the value? 20,000 into 72,222 divided by 172,222. 83 87. Debt will be balancing 11,613. Dividend income is, listen, dividend income is other company paid a dividend of 13,000. I will get 8387 upon 72. 13,000 is the dividend for 72,222 investment. My investment is 8387. Wait for some time. Interest income is either you can say 11,613 into 7%. 7% is the rate of interest, or 11,711, sorry, 1,300 interest. So 7,000 interest into 11,613 upon 1 lakh, same number you will get. Same number you will get. Can you tell me the dividend income? Give me the dividend income. 13,000 into 8087 upon 72,222. How much is the income you get? 15. And the interest income? 81,813. Put together 23. No surplus cash. Increase in income. I'll explain this in some time again. 323. Listen, I have 20,000. Exact 10% debt, exact 10% equity, exact 10% dividend income, exact 10% interest income, exact 2,000 income, no increase in income. Surplus money is there. Surplus money is there. No increase in income. Surplus money is there. If you invest full money, 20,000 is the EBT. 20,000 is the EB. Sorry, 20,000 is the money available. That 20,000, break it in the ratio of 72,222 1 lakh. Whatever money you invest, 13,000 into your money invested divided by 72,222 is your dividend income. 7,000 into what the debt you gave divided by 1 lakh. Divided by 1 lakh is your interest income. Is your interest income. Once you get that, you get a surplus income of 323. Surplus income of two proof is there. Either increase in income or have surplus. What will I do with this 2778? Invest somewhere else and earn money. Invest somewhere else and earn money. Any doubts on this? Please write this now. Start writing this now. I'll explain one more time. You first write this now. Write this. I'll explain again one more time. you can either invest the full money in the proportion of debt and equity, or exact 10% 15 20 20 whatever it is, exact percentage. If you invest exact 10%, no increase in income. If you invest full money, you will have increase in income but no surplus cash. Clear? Any doubts in this? Any doubts? I'll repeat. Primary arbitrage, we move from a company having borrowing to no borrowing, personal borrowing is created. Reverse arbitrage, we move from a company having no borrowing to a borrowing, so we create a personal opposite of borrowing. Opposite of borrowing is called investment. Opposite of borrowing is investment. Any doubts on this? Understood?